Hello and welcome to the LA Venture Podcast. We're David Waxman and Minnie Ingersoll, partners and investors at TenOneTen.
I am thrilled today to be chatting with Deb Benton of Willow. Deb is an expert in early-stage consumer-branded companies. She was the president and COO at Nasty Gal, and before that at ShoeDazzle, COO at ShoeDazzle. She's a board director at the Books, Carbon 38, TomboyX, and public company The Leaf Group. She has a really impressive track record pre-Willow, investing in Tapcart, Skylar, Thankful, and now she has her first fund, Willow. Congratulations, Deb. Thanks for being on the show.
Thank you. Thank you so much. It is such a pleasure to be here.
Yeah, it's really exciting to see you raising your fund. Tell me some more about Willow.
Yeah, so I've been investing for the past 6 years, basically with the thesis that consumer brands, early stage consumer brands, need to be assessed, valued, capitalized, and scaled in a way that is unique to them as a category. Different than a SaaS company, different than a software company. So I started investing about 6 years ago, angel investing, check sizes, generally anywhere from 50 to 200, into these seed stage rounds, and had a strong belief that the founders and the companies not only needed capital, but also needed operational and strategic support where I could provide help. So I took a lot of advisory seats, I took board seats, and I have 15 companies in my personal portfolio. And then about a year ago, decided that it was time to institutionalize, because what I was finding was that for these early stage rounds that I was doing, there really wasn't an institutional source of capital with this particular thesis. And so I decided to institutionalize exactly the same way that I had been investing for the past 6 years. I really wanted to do it with another woman. And I'd known Amanda Schutzbank for many years. We have been invested together. Amanda was at Amplify, which is a fantastic early stage pre-seed fund here in Los Angeles. And we did a first close on May 1st. And we just finished our first deal last week.
Congratulations. And so will you be leading, you'll still be focused on seed investments. And will you be leading those rounds? Will you be co-investing some of both?
Yeah, probably a little bit of both. Ideally, we'd like to lead as many as we can in the consumer brand space. And within consumer brands, we are more focused on self-care, personal care, which includes beauty, color, skincare, hair care, anything to do with personal grooming. Health and wellness is another big category that we're really focused on. And I'd say the intersection between those two is really growing. I really like apparel and accessories. However, I'd say the lens that we look at those opportunities, it needs to, we're a very values-led, we have a very values-led investment thesis around consumer brands. So with those companies, you know, they need to have something that's highly differentiated. It could be around sustainability. It could be around supply chain transparency. It could be around production or fabrication. But there needs to be something that is incredibly unique. It's a very tough category, and I think to really stand out, you need to have something that's very highly differentiated. I also really like food and bev. I don't know that category as well. So in that area, I would probably tend to participate with a strong lead that knows that. Just the sales and distribution is very different than what I'm used to. So, but I really like the category, again, particularly as it intersects with health and wellness. We have carved out a small portion of the fund for what we're calling consumer tech enablement. And similar to Thankful and Tapcart that I have in my personal portfolio, those companies support the brand or support the consumer's experience of the brand through technology. I like that as well. So we've carved off a section of our fund that will be dedicated to that. Those deals we will participate in. We won't lead those. There's much better funds that are very tech-oriented that can lead those.
Got it. And so maybe you've answered my first question, which was going to be about how do you assess these companies?
I would say broad table stake criteria for revenue stage. We're looking at 1 to 5 million in run rate revenue. The categories that we're really interested in, and specifically the companies we're really interested in, have very strong product margin profiles. E-commerce has its own set of challenges. In some ways, it's easier than physical retail. But when you look at things like distribution and outbound shipping and returns, that's an added cost that is substantially more than physical retail. So, the P&L is a little bit different. You really need to have a pretty robust product margin profile to be able to succeed, I think, online, unless you're going to be a massive volume play like an Amazon, a Target, or a Walmart. And that's not an area that we play in. They do that very, very well. I feel no need to compete with them. We're kind of at the very other end of the spectrum, focusing on very emotional, connected brands.
What line items are you really looking at to understand whether it's a healthy business?
Yeah, so the first line item that I would look at is what I call product margin, and that's simply your product revenue minus your direct product costs landed to get to your warehouse. So before any kind of variable costs around your warehouse, it's simply your landed product cost. It varies by category. I'd say for personal care, I'm really looking for 70 point plus in product margin, at least scaling to that. Some of these categories can be over 80 as well. That's fantastic. It also happens to be that those categories, which makes them even more attractive, the return rates on those categories tend to be low. So accessories tend to have a very high product margin. They tend not, because there's not a fit involved, except for footwear, they tend not to have high returns. Beauty, skincare, personal care, grooming products, they tend to have a much lower return rate as well. And they tend to be 73 or above in their what I call initial markup, or their product margin. With apparel, and again, this is why we probably have an even tighter set of criteria around apparel. It's hard. Returns tend to be much higher, particularly in categories like dresses. Returns can be anywhere from 35 to 50%, which is crazy. And it really, really upsets the income statement when you have those kinds of returns. It also affects LTV and repeat purchasing because you tend to have, more dissatisfaction on the consumer side. So there's secondary effects of having a high return outside of just the financial implications. I would say for apparel, there's a couple of different ways that you can tackle apparel. If it's a pure vertical integration, I would really want to see 70 points and above again, or at least scaling to get there with volume. Some of these companies are taking what's called a hybrid approach, and they are, in essence, outsourcing some of the internal design and production costs, and they're doing it with a partner. So that's a blended model. I would want to see probably 63 to 65% on the product margin there, because you're in essence eliminating some of your internal costs, which usually reside below the line. Anything below that, it starts to get really hard, because the next line item that I would look at is gross margin. And for me, that's product margin minus your net shipping costs, minus your credit card merchant discount fee, and minus your packaging fees. That gets to gross margin. Anything below 50% on a gross margin for me is really, really tough, unless there's a recurring revenue component to it. So if it's subscription, I can entertain that, because I can have a safer assumption of LTV than I can around the one-off purchasing.
How do most of these companies, because you said you're investing when they already have a 1 to 5 million run rate. Mm-hmm. How do most of them grow up? Most of the companies that you're meeting, did they do a pre-seed, or are they new to venture when you meet them?
The vast majority have raised somewhere between 250 and 500,000 by the time that they get to me. Some of them have crowdfunded. They've used that really effectively. And that's a really interesting, much more than I think tech companies, these types of companies tend to bootstrap. Because think about it, but these days, I've been in this world for so long. 20 years ago, you needed to build everything in-house, right? There was no Shopify, there was no social media, there were no 3PLs, right? All of these costs that have come down precipitously allows companies to scale, or at least get somewhat product market fit before they really go in and take a lot of capital. That didn't used to be the case.
One other thing that you said to me, because I was asking you about a particular investment opportunity, you said, look, you don't like investing when there's a product if there isn't a brand, a platform, something more there. How do you know when something can be a platform? Like, what does that mean to you, I guess?
Yeah, it's a great question. And I should say, it doesn't mean that that single product companies can't be remarkably successful, because they can. They absolutely can. Like, look around anywhere you look, especially in homes. You can certainly have companies that have done extraordinarily well with one product, and maybe they go on to have a couple of others, but it's really a product focused company. It's just not what I'm particularly interested in. I really get behind and get excited by companies that are built on values. I think today's consumer, particularly the younger consumers, but I think we're all kind of getting there now, we want to use our wallet to shop with brands that support what we think is right. This younger consumer is far more interested in things like sustainability and impact on the earth. The type of labor that's being used, supply chain, like far more than consumers of the past have been. And I think it's fantastic. I think it's great, because I think capital is power, and consumers are exerting the power that they have and should have.
Okay, so that's some about what you're looking for. I could ask a lot more questions, but let's talk about like how you're actually helping these companies as they go through scaling. And, I'm specifically very interested in what sort of the playbook is and where you think that playbook is going.
I think team and recruiting is something that I am particularly interested in, and coming from my days of operating, saw how much leverage you can get out of having the right people in the right seats. So I think that's probably the first thing. The second thing that I'm particularly interested in, and I think these companies need support on, is just a fanatical obsession around the consumer and exceeding consumer expectations. Today's consumer is so savvy and they have so many options, as they should. They can pick and choose. So really understanding, and the great thing with digital brands is you get access to a ton of very rich data around your consumers, and you can see things that physical only brands really can't see.
Are there certain things there around knowing their customer that are non-obvious, or that you see some companies doing really well that other companies aren't doing as well?
You'd be surprised at how many companies don't just actually talk to their consumers. It's probably one of the first questions that I ask. We'll be in debate after debate about what's going on. And, my question will be, have you randomly selected 50 customers and just called them? Literally just called them. It's the greatest source of information. And many don't do that. You don't have to go out and spend a fortune on consumer insights and all of these different databases of, prescribed information about your consumers. I think having that one-on-one connection with them and just randomly having a conversation can be incredibly informative. I also think putting a framework around how your consumer makes their purchase decision and how your consumer values your brand, like what problem is that are you solving for your consumer? Really getting deep in on that. Often, I think we have our own ideas around what problem we're solving, and then you talk to the customer and it's actually quite different. And so I think that adjusts kind of the hierarchy of messaging of how you build your brand.
I've heard people say, well, one reason to open an offline presence is because it gives you the chance to know your consumer better. And I never totally understood that, because online I have so much more data at my fingertips, but maybe why do people go offline? What do you coach people now about when they should go offline and why?
Yeah, I think it depends. There's no one set answer. I think it depends on the category. I think it depends on the environment. I think it depends on the opportunity. I think it depends on how much capital is going to be required. I think it depends on the strategy, what you're trying to achieve. I do think that the most successful brands are where that consumer is. The consumer doesn't get up in the morning and think, oh, today I'm going to be an offline shopper, and tomorrow I'm going to be an online. You know what I mean? Like we need those terms for our own internal structure and how we think about it and how we allocate resources. But the consumer doesn't think that way. The consumer just wants you to be wherever she is. So again, I think it comes down to knowing your consumer, what she will value, where she shops, what brands are aligned, where do you want to be, and what you're hoping to get out of it. I have seen strategies that some brands simply are looking at it as a marketing expense, and as long as it breaks even, they're fine with that because they believe that the brand halo effect is sufficient and they can justify that expense. They don't want to lose money, but they're fine if it breaks even. I think that that's interesting, and I think that that's good for some of these brands. Others, which are more highly dependent on physical distribution, need them to be money makers. So that would be a different set of criteria and decisions that those brands would go through versus, a brand that is 95% online and simply wants, 2 flagship stores, one in New York and one in LA. For marketing purposes.
It seems like it's getting more and more expensive online. So maybe that's your point, which you need to know where your customers are first and foremost.
Yeah. I mean, look, paid acquisition has never had, the consumers that you acquire through non-paid have always been more valuable. Think of it as you've got these concentric circles going broader and broader. You're right in the center. Your first few circles, they're going to hear about you because you happen to live in their sphere very directly and you're catering exactly to them. And they can become your ambassadors, right? They become your evangelists. They're the ones that you want to figure out how to make so happy, and they go out and tell the world. And so they're in essence, an extension of your brand. There's not a billion of those people, right? They're very limited. So then you have to figure out what's your second degree? How do you attract them? And it could be through these evangelists. It certainly can be through paid. My concern with, like the Facebook advertising or Instagram, I'm just not actually sure how effective it is. I see it's very expensive, and the way that Facebook likes to attribute it, it gives them very, very, very considerable attribution, like I think 30, 60-day windows, which is a little bit ridiculous. But I do think Facebook today, I see it acting in a very similar way that TV of 10 years ago acted. It tends to lift all channels. So, I can't say with complete conviction from a data perspective that's happening. I believe that to be happening. And I've seen enough of my companies kind of lower and increase their Facebook spend and kind of corresponding effects on all channels. So I do think it's acting as kind of this enhancer of other channels. That being said, not everybody's on Facebook. Gen Z is probably not hanging out on Facebook. My new obsession is TikTok. Like, I'm obsessed. So I'm trying to figure out, and it has a different nuance to it than Facebook or Instagram.
Do a lot of your companies work with influencers? Do you coach them on that some, help them take best advantage of that?
Yeah, again, I think it depends. I mean, don't forget, I was with Brian when he launched ShoeDazzle with Kim Kardashian, who I would say is probably like the OG influencer. That was back in 2008, and Brian did a phenomenal job with that. I mean, that was extraordinary. Kim's brand, I think, was very highly aligned with the ShoeDazzle brand, and it was something that her customers really want. I've seen disasters, in other situations where, companies are just trying to throw talent or influencers at a brand, and it doesn't make sense whatsoever. And there's like this cognitive dissonance. The consumer goes and says, wait a minute, why is this individual repping that brand? It completely doesn't make sense, and it backfires, and it's a waste of money. I've seen the trend has been, I would say in the last few years, to move more towards micro-influencers. There is a general trend happening now, and I can talk about this because I've spent far too much time on TikTok. TikTok is really a platform for the people. And so, if you can think of Instagram is that perfectly pictured, polished view of everything's perfect, whether if you're an influencer or even a person, like everybody's life is perfect. I mean, it's so deceiving. TikTok, on the other hand, it really is built around, I think, the everyday person. And I think we have moved from a trend-wise to that. I'm not sure the celebrity culture is going to be what it was beforehand. I shouldn't say that because I work with a lot of talent.
Okay, quick break where I ask you guys if you could all give the podcast 5 stars. Just if you could give it 5 stars, come right back. I would greatly appreciate it. And I'll suggest, while you're thinking about it, to go write a Yelp review for some small business. It's an easy way to make someone's day. if someone's at 1 to 5 million when you invest run rate, what's the next stage? How do you think about the stages after that? Not just like from a funding point of view, but growth.
It's not that it's exactly this, but in general, brands that are doing, it's going to be more frequently kind of 1 to 3, 1 to 4. They raise a seed. The seed could be anywhere from $1.5 million to 3. That's a typical seed. Valuation is going to be anywhere from, say, 5 to 10, roughly. We're trying to stay super disciplined around being sub 10 for us. The next round, they're probably going to raise, in general, 5 to 7. My guess it's going to be, they'll be doing 8 to 10 in revenue, and they might raise anywhere from, let's say, 20 to 30 pre-money valuation. That's kind of roughly where I see it. And then after that, many of these brands, I want to push these folks to get to profitability sooner rather than later, at least on an order basis, and ideally, contribution level. So, getting them to that point, they can either, some of these brands are selling at that point in M&A, they get to $30, $40 million revenue, and they're either break even or slightly positive, and the acquirer knows that with scale, their operating margins are going to improve even more. They could sell for a very nice multiple in the M&A market at that point, or they could take in a growth round from private equity, from a strategic, sometimes even a family office.
Are there any other big things that change between the way a company looks when it's a $1 to $4 million company and the way it looks when it's a $10 million company?
You're going to see margin improvements across the board as you scale, just because you're going to have the volume of goods. So you can negotiate better rates for your product margin. You can negotiate better shipping rates for that goes into your gross margin. Your 3PL, you're going to have greater volume. You're going to figure that out. Your data is going to be better. It's going to decrease their work requirements. So you should be able to negotiate better rates there. So there's it's an ongoing process, always trying to bring your costs down as you scale. That never ends.
I've been dying to ask you about what we're seeing today with some of the sort of darlings of the e-commerce world, the online e-commerce people, and Brandless, maybe Outdoor Voices. Like, what are you taking? What are you seeing when you look at these companies?
Well, let me first say it's very easy to be an armchair critic because I've been on the other side.
Of course,
and
totally.
I know it always, it's so easy to be on the outside looking in saying, oh my goodness, like they did this wrong. I think for a lot of it comes back to my personal thesis around how this category of company, these consumer brands, digitally native consumer brands, how they should be valued and how they should be capitalized, meaning how much capital they should be bringing in, and really much more quickly they should get to profitability. We should be backing into the valuation. Really, where do we think that this company is going to end up? We know from the data that a successful exit, the vast majority are going to happen in M&A, right? 200 to 500 would be a fantastic. So if that's the case, any venture investor going in with a $300 million pre-money valuation, well, they're not going to be super happy with that exit. So they would have to really believe that is going to be $1 billion enterprise value when they exit. That's possible. It does happen. We do see it. We do see some of these companies going public. It's just not the norm. So when you think about a portfolio construction model for a VC, they're counting on a couple of their exits being those $1 billion exits. So I completely understand that. But we can't force fit that thinking into what we know how these consumer brands scale and naturally exit, right? Like we can't say, oh no, we need that, so we got to figure out how to make you that. Chances are that's not going to happen.
Right. So you're saying the model is a company that's maybe doing 40 million in revenue that's looking at a couple $100 million in as an exit in an M&A sort of situation.
That could be an option, or it could be that it raises, right? It could raise and do a
Sure.
big growth round, but then whoever comes in, that investor, and if it's a consumer brand, it's probably going to be a private equity investor. Not always, but probably. They're going to want at least a 3 to 5 times return. That's what they're going to model out. And I think consumer brands, I think they're just very different. I think they grow and scale very differently than a SaaS company, and it's not logical to me that we assess them and have the same sort of expectations when they're fundamentally very different companies.
Yeah. Well, that leads me to I'm super interested in some of the stories of how you grew and scale either Nasty Gal or ShoeDazzle, but maybe like Nasty Gal, you took it to 100 million in revenue company, right? When you were there, what were the good parts? What were the tougher parts?
Well, I joined Sophia. Sophia Amoroso was the founder of Nasty Gal, and she had built this really beautiful brand. And I credit Sophia with bringing this aesthetic and this brand online where nobody had done it yet. For a long time, she wasn't even producing, Nasty Gal wasn't even producing their own brand. It was, they were just curating it was really a retail play. But because she did it all online and she did it under the brand of Nasty Gal, she was one of the first, I think, to be able to create a brand around ostensibly a retail play. And that was, I really credit her and her early employees, and that company just took off beautifully. I think the challenge came in, we raised at a pretty high valuation. I would say over the years, the competitive environment changed. So, there was a lot of focus on Nasty Gal, a lot being written, and a lot about the success of it. And so that welcomed a ton of competitors. I would say that, we probably welcomed in 10, 15, 20 competitors. And a lot of the time they were selling exactly what we were selling and simply undercutting us by 50 cents. We invested a lot in trying to build our own brand, and that cost a lot of money. I'd say operationally, we spent too much. And I take full responsibility for that. I think we had raised a really big round. We spent too much. We probably spent it in the wrong ways. We weren't focused on nearly as much on profitability that today, to do it again, I would certainly be focused on. But, there's a lot has been said about Nasty Gal, and everybody wants to come up with this. Oh, it was this. It wasn't. There was a whole bunch of things going on. Things are changing all the time. That's the world of early stage.
Yeah. And, in addition to that, not just did the business struggle, but Sophia got so beat up in the media.
Oh my goodness. Yeah. I mean, it's so tragic. I mean, it's just tragic. It's quite upsetting. It's quite upsetting.
Yeah.
I mean,
well, yeah, go ahead. I'm curious your perspective on that.
Yeah, I think it's super unfair. There was so much speculation. I think we live in a weird society where we want to, put people on pedestals and everything's great. And then there's a misstep and we want to pull people down, so strongly. And frankly, I think women get it harder. I really do. And I think it's completely unfair, and it got deeply personal. It used to break my heart just reading the articles that were being read and the words that were being read. I mean, they were vindictive and mean and personal and completely unprofessional. I have no issue at all about talking about or even speculating about, what went wrong or, what decisions, because we can all learn from that. But she was often eviscerated.
But then when you're investing in companies that are built on values, and this is some of what you're looking for, sometimes that gets very infused with the founders themselves, right?
I mean, it's an interesting question. I would say at ShoeDazzle, we frequently had the conversation around the need to separate the ShoeDazzle brand from Kim's brand. That the company had to stand on its own. And I would argue that we were successful. I mean, the company's still around today and Kim's not involved. And I've heard Gwyneth talk about Goop and how she really wants Goop to stand on its own. And to be honest, I think she's actually done a really good job about that. I think Goop's brand is powerful and it does stand on its own. And whether or not you're a fan of Gwyneth is almost, it doesn't really matter. You can still be a fan of Goop. I think that's the place to be.
And on your front, who do you go to for advice? Like how are you navigating your own career?
Oh my goodness. Yeah, what a great question. I have a lot of friends, a lot of colleagues. I have for our first close, we were very fortunate to have extraordinary LPs. Some fund managers, some really well-known fund managers have joined as individual LPs. They are an extraordinary source of mentorship, questions. Sometimes it's just questions around fund mechanics, and they're very helpful there. So those folks, I have great female friends and colleagues like yourself. I mean, I'll be calling you for sure. That especially in the investing world, there's not too many of us. And I think that the more that we build our own community and reach out to each other and support each other, that's very helpful. Again, a lot of these are uncharted territory. So I think the more that we kind of get together, band together, create communities to support one another, we can encourage other women to come in. It's hard.
Absolutely. That's why I'm really excited about Willow. I would say that mentorship is great, but actually when you can have women who can make investments with capital behind them, that's
huge.
It's game changing. Yeah. Well, great. Thank you for coming on the show. And I'm so excited for Willow to be part of the LA ecosystem, and congratulations.
Thank you so much. I love it. Happy to do the show anytime. It's a lot of fun.